the famous saying, a good negotiation is where each party is equally unhappy rather than happy. I think when you think on recovery and defaults and enforcement, there are some cases where it's a real asset, it's pretty simple. But if it's a business, businesses usually have most of their intrinsic value in the business themselves. And just trying to take over the keys, if you've had an entrepreneur running a business for decades or generations, we can't kid ourselves. You're not the person to come in and take over those businesses to get the extract the best value. So very often then it's a delicate balance between using your stick and your enforcement, but also wanting to work with the family or the entrepreneurs.
Welcome to Brave. Learn from Southeast Asia's best tech leaders. Build the future, learn from our past, and stay human in between. No BS on success. I'm Jeremy Au, venture capitalist, serial founder, Harvard MBA, science fiction nerd, and dad of 2 daughters. Every week, we debate startup news, interview changemakers, answer listener questions, and share personal insights. Join our movement of over 40,000 members and get transcripts, resources, and community at www.bravesea.com. Stay well and stay brave. Join us at the Startup Conference Echelon X. Engage with over 10,000 of Asia's innovators and decision makers on May 15 and 16 at the Singapore Expo. We have 30 exclusive complimentary tickets for our podcast listeners. Sign up and use the promo codes BravePod or ECXJeremy to claim your free tickets now. Hey, Jason, really excited to have you on the show. You are building some really interesting stuff out in Southeast Asia and broader beyond. And you have this interesting blend of both a founder and an investor hat. So I really wanted to share your story. Could you share a little bit about yourself, Jason?
Yeah, thanks, Jeremy. And it's great to be here. I'm a VC and I'm also a founder. So I started my career as a lawyer in Australia. After 6 years, moved to Hong Kong, arrived not long before the Asian financial crisis. Everything was in turmoil. And I was sent down to help the bank office of this law firm, Baker McKenzie, I was working for, to help them for 12 months because they'd never had a public company go into insolvency, and the majority of public insolvent because they all borrowed in US dollars. And then the bar lost the peg and they all owed far more possibly pay back. And that 1 year turned into 7 years. And it was a very interesting time of my life. And then one of my clients had set up a private equity fund in Singapore and they were doing special sits lending throughout Southeast Asia. So I joined them, spent 8 years then. And after that, I moved into VC. So I co-founded a VC fund called Qualgro with 2 other partners, B2B focused, Series A and B. And I wanted to go earlier stage because I really believe the best risk return in Southeast Asia is going seed stage if you can access more. And so you have to be very data focused, which is what I was focused on. So I joined the team at January Capital 5 years ago, and we're B2B focused, seed stage investors on the equity side. And we've just launched venture debt for growth stage companies, which is a space that's really underserved. I also founded a company called Alternatives.pe, which provides information on private companies, startups, private equity, M&A, etc., fund performance, family office, LPs, by pulling the regulatory filings across Southeast Asia and Australia.
So tell me more about why you decided to be a lawyer. Did you, watch something on TV? How did you kind of get started on that route?
Yeah, look, we grew up in LA Law and all those shows were going on. And it was all very glamorous, but we all knew it didn't really look like that real life. For me, the motivation was wanting to really know what my family's rights and people I knew. I'd seen situations where I just thought, this can't be right, this can't be fair. But if you don't know what your rights are, if you don't know where you stand, you really don't know what you can do. And so that was the driving force. And that stuck with me. I'm always been a believer of look at a situation and think, are they allowed to do that? Can they do that? Can they get away with that? What can I do? And I think to that extent, it served me well. I spent 15 years as a lawyer in private practice. I don't think it's something many people want to stick around. It is a real grind. Some parts of it are exciting, but there's a lot of work that you don't appreciate. It's all the stuff that goes on with building clients, timesheets, managing or recording every 6 minutes of your working life. And so that was the reason I got into law.
What was your experience in law?
I came from pretty humble backgrounds. I was the only one of 4 children to finish school, do law and do a master of laws and stuff like that. So I was really changing. It was a bit of a sea change for me because I came from a background where I was going into much more operational. I was one of the second largest law firm in Australia. So just working out where I belonged and making sure I felt justified in where I was because I was coming from such a different space. But then I think I really had a fantastic time in the first few years. I had a great mentor, both on a business level, professional and personal level, and spent 6.5 years working at that firm and with that particular partner. And it was a life-changing thing for me. And so that opened myself up to opportunities. Back in that time, there was a shortage of lawyers globally that the UK firms were recruiting like crazy. But I was going to go to London, but the last minute went to Hong Kong because I thought Hong Kong and Asia would be more exciting. And I think that was the right decision.
Wow. What was it like? Because that was pretty much the heyday of Hong Kong in terms of M&A, corporate law.
97, I got there and it was extremely busy. Baker's was the biggest firm there, 750 people in one office. It was the largest law firm in the world at the time. And it was really interesting. And I came from Brisbane, where you worked on very limited sized transactions, to where we were flying all over Asia, big deals, which was quite exciting. And then about 9 months later, the Asian financial crisis came and I was a finance lawyer and lending stopped. It stopped dead. And on one day, our firm fired 45 lawyers. And I'd only been there a year and I could see the person on the left and the person on the right who spoke Mandarin and Cantonese and been with the firm for 5 years, packing their bags, and it didn't look good. And they came in to see me. And that's when they said, "Do you like Bangkok?" And I said, "I've never been." They said, "We really need someone to go and help. There's no foreign senior lawyers down there." So yeah, it was a pretty exciting time. It was the handover period. It was incredibly busy. And then I became a restructuring lawyer like many other finance lawyers. And that was a really crazy part of the world because many companies in Southeast Asia, very big, had borrowed in US dollars and they were earning in different local currencies. And all of a sudden their loans had tripled, interest rates had doubled, and they were dead. But there was very weak court enforcement. And we all know if you shut down a big company, you don't necessarily get all your money back. So it was definitely fun and games and lots of exciting things happened and a lot of crazy things happened. Some of the entrepreneurs, these big founders of these big tycoons, they would have people arrested as they come to the airport if they were coming from the big accounting firms, etc., saying, "You're here for meetings, aren't you? Technically, you're working. You need a work permit for any day." And the police would pick them up for a couple of days. So it really got quite serious. Of course, there was some violence and limited parts, which was regrettable. But yeah, by and large, it was a very eye-opening experience.
Asia financial crisis is very much like a big, I don't know, it's a PTSD or trauma moment for a lot of folks in Asia. You must have seen it during that moment. Any other like moments that stand out for you during the Asia financial crisis?
We were working on one restructuring where there was calamity over one of our partners. An accounting firm was set up in a small town where this company operated and was shot, killed. And that was a signal. And that just kind of thing here in emerging markets where it's quite unpredictable in that sense. It just showed the lengths that people would go to. And it also showed that you'd had to have a different approach. You couldn't come in with a Western culture of Anglo-Saxons saying, "This is our creditor rights in our country. You're going to play game and do it exactly the way we want you to do it." In a country or countries and emerging markets where that's not how things are typically done. So you had to learn that delicate balancing act of how you could try to get things done to protect your clients' rights, but also you had to not be completely abrasive because the consequences were quite unknown and potentially dire.
And that was a big moment because after that, you went off to move from Bangkok to Singapore at Clearwater Capital Partners. So what was the context of that?
Yeah, so one of my clients at Baker McKenzie, the law firm, had actually set up Clearwater and they got to 500 million AUM and they needed a general counsel and someone to be involved. And so I'd been in Bangkok 7 years. I actually loved it. When I went down there for the first time, I thought it was a terrible place. It was hot. I thought as a Western, it was dirty, and but lived there for a few years. I thought it was an amazing place, very friendly people, great food, lots of diversity. So they'd set up a fund. They wanted someone to join them. I didn't plan to live in Thailand for the rest of my life. Not that that would be a terrible thing. Many Westerners do, but I wanted to get back to a financial center. And I actually thought I'd never live in Singapore out of all the places in Asia, because I thought it's very small and I thought monotonous. But of course, Singapore has its own charm and it's a great place for work. There's lots of opportunities and it's a city that just continues to outperform and to grow. So that's when I moved. We grew the fund to about 2 billion, a bit over that. And we were doing some interesting stuff. So it was special sits. So we were buying distressed loans in difficult countries and then trying to enforce, looking at the value we could get, or we were lending at the periphery, lending at very high rates to companies we knew that would struggle, buying loans to own, to take over assets. So doing all that kind of stuff where it's one thing to act on the lending side, and 1 in 100, you might have to do some enforcement. You might be involved a little bit and you hand it over to the litigators. But when you were really just doing that day in, day out, you had to run the process and create the efficiencies and work out what really worked to enforce in Indonesia and Thailand and Vietnam, because it's not the same as in the European countries. And we worked that out. So we knew what we could do. And we were very successful at getting our money back on a number of occasions that people were surprised at. But it certainly took a bit of learning.
I think that's a really interesting point because what the rights are for the shareholder, and especially I think in good scenarios, that's everybody's happy, right? And in bad scenarios, then how do you even carve out that pie? So could you share a little bit more about what the dynamics are around getting your money out slash negotiating there?
Yeah, look, another way to, I think, the famous saying, a good negotiation is where each party is equally unhappy rather than happy. I think when you think on recovery and defaults and enforcement, there are some cases where it's a real asset, it's a security, it's a property. Okay, it's pretty simple. But if it's a business, businesses usually have most of their intrinsic value in the business themselves. And just trying to take over the keys, if you've had an entrepreneur running a business for decades or generations, we can't kid ourselves. You're not the person to come in and take over those businesses to get the extract the best value. So very often then it's a delicate balance between using your stick in your enforcement, but also wanting to work with the family or the entrepreneur to say, well, how do we maximize value for everyone? They don't want to pay anything. You want to get all your money back. How much pressure can you exert and get their help to some extent using the leverage that you have? And that was a bit of an art. And I think that's on these operating assets. If you just try to get in there, rip it out, you would see the value probably deteriorate. That's what I think the biggest challenge was.
Is there any differences that you saw between, say, Europe and, say, Australia versus Southeast Asia and Asia in terms of this set of negotiations?
Yeah, I didn't actually go to Europe. So between Australia, it's a very efficient legal system that is very creditor friendly and cut and dry. In Australia, you would look at what are your rights, what's the value of the business, what's the value of the assets, and it would be you would discuss a little bit with the borrower, of course, but you would not give them much leeway, and you would just be taking over those assets very quickly without going to court and selling them. You wouldn't even have to go to court most of the time. I did lots of enforcement in Australia, and you don't have to go to court. You can just kick down the doors. Not that we do that. You hire people to do that when people aren't home, because you can't use violence, of course. And then you change the locks and you put a sign up that says, this is after there's defaults, there's discussion. You don't do this in a hurry. But when it's clear that they're not playing ball, you ask them to vacate, they don't vacate, or even a residential property, but it's a commercial property. And then you go in on up time when they're not there, you change the locks, you put a sign up that says, if you come back in, you are trespassing and you will be prosecuted. And that's the truth. So it was incredibly creditor friendly. You would never do that. In Indonesia, it'd be very risky kicking in the doors and trying that. And legally, I don't think you probably could. Or it's some of the times you probably could do some things, but no one's ever thought about it. So yes, a completely different approach because of the effectiveness of the courts and the sophistication. And also you've got the questionable partiality of the court system. You can be pretty safe in Australia at the lowest level and the highest level. You've never heard of anyone ever taking money to be influenced about how a decision is made. You could not have that certainty in quite a few countries in Southeast Asia, even at high levels. And the decisions that have come out that I've seen have been extraordinary. They have very clear cases, and the judges come out and said, yes, he borrowed the money, or this company borrowed hundreds of millions of dollars, but we think it's actually illegal. It's like, so you get answers like that. Now, you knew that if you got to the final court, you have a reasonably good chance of turning over that rubbish, but you always had a question. So they had leverage with that. And so you'd have to take that into account in negotiations, continue on, but very different approach to emerging markets.
And here's interesting is because you also were doing the private equity side, and then after you moved on to alternative investment advisors. Could you share about that?
Yeah, that was more consulting. So still consulting into people doing special sits investments, and did some work for Goldman Sachs, some of the other big funds as they look to invest or buy distressed assets. Sometimes they were going into markets they hadn't had with. So that was what I did for a few years before taking the big sort of step and going into venture capital.
And that's a big one because from consulting, you're going into Qualgro and venture capital. Could you share more about that? This is very early as well in the ecosystem.
Yeah, back in 2015, we launched Qualgro. And a couple of things. Certainly, I was out of my depth because I'm an older lawyer, not a young tech savvy person like yourself who really understands these new business models so quickly. And there is this age thing. I knew what I could add value and where, but it was going into a career path where it was very different. One of the things that I noticed from venture capital and private equity is in private equity, you are cordial, but you're very focused on your rights. These are my rights. These are your rights. Things don't work out, I'm going to take out whatever action I can to get my stuff. But then in venture capital, if it doesn't work out, there's nothing left, usually. So there's this mentality of we're all in this together. And I really noticed that in the first couple of years where it was like, we're not fighting with the founder saying, hey, this is my right, I own this. It's like, no, we want to help that founder as much as possible because if he succeeds, we succeed. And I really, really liked that. And that was such a nice change from being banging the fist on the table and doing all that other stuff to saying, no, the whole mentality is different. We work together, you work with other VCs, we're all in this together, and pretty much it's one for all and all for one.
And what did you learn else in venture capital? Because 2015 was early in the ecosystem. What were other things that you learned along the way?
I learned everything because I didn't know much about it, to be very honest, when we started. So one of the things we did, my other partner, Hang, was a very methodical in his approach, very senior partner at McKinsey. And what we first did was we spent quite a bit of time to work out what is our strategy. So venture capital, of course, you've got different stages, countries, sectors, etc. And we said, what do we do in Southeast Asia? And we spent a lot of time and we analyzed all the other VC funds methodically. And this is what we came up with in 2000. We started this in 2014 as the majority of VCs were B2C. Actually, they were all B2C predominantly. And we really thought about this and we thought to be successful in B2C, you need an enormous amount of capital to get to break even. You have to have a huge valuation to have a successful outcome because of the amount of capital you need to raise. And therefore you need to be very, very big. And to do that, you can't do that in Thailand. You may be able to do it in Indonesia, maybe. And that's still the B2Cs are going to be able to make it work. So you had to be regional. And B2C does not go well transferring through cultures and language. And so we thought that's a really tough market. B2B, people weren't really interested in, but B2B gets the profitability much quicker, much more capital efficient. You can have valuations at exits at much lower valuations and have good outcomes for everyone. And they do go for languages and cultures much easier because you're not selling to the consumer. So we've had exits. Qualgro, $150 million in that range and done 10 to 20x. You won't see that in B2C businesses. So from the outset said we are B2B. And that was one of the learnings. And in January Capital was the same. It was very clear. We're a B2B fund. But what you have now seen, you talk about startups pivoting. The majority of VCs have pivoted. They are now pushing B2B. Because they've realized that, look, there's just very few exits in a B2C. There's a lot more in B2B. And what kind of exits do you have? Do they look good? Grab, it raised 20 billion and its valuation is 12. It's the worst performing startup in the history of Southeast Asia in terms of money lost. And look at the other ones. There's not a huge returns for every investor. So that was one of the learnings. But for me, it was just realizing just how many opportunities there are. There were people who were, I loved the environment, people who were leaving comfortable paid jobs to take risks. And that's exciting, right? To people who believe in what they're doing, want to control their own destiny, and often very smart people, and they're determined and knowing full well, as you know very well, Jeremy, that most startups don't succeed. So it is huge risk. And I love to be in that environment where people really believe in themselves and are prepared to take risks for really strong outcomes.
And what's interesting is that you were there as a partner at Qualgro, and then you decided to become a founder and continue investing as well. Could you share about that?
Yes. And this to me was, we were using PitchBook and we were using Trustful, but we looked at the data on our own companies and they weren't covering PitchBook did even half of our portfolio. And then when we looked at the data they have on fundraising for the companies they did cover in our portfolio, it was wrong 40% of the time completely because they missed rounds. Rounds were reported, they couldn't pick it up. Rounds were reported ambiguously, which is very common in Southeast Asia because founders intentionally want to give people a different impression. And they would pick up what the founder wanted you to believe, which wasn't the reality. And they didn't have anything we wanted. The valuations, cap tables and financials. And they wanted 30,000 a year and it's now 30,000. We thought this is crazy. So I knew as a lawyer, you could get 100% accurate data on each company, but you'd have to solve a lot of issues. Cost being one, because you have to pull every filing for every startup. And then you have to work out how to get notified when companies raise money or file financials, and them are not reported, and other issues. And so I thought, this is what I want to try and do. So I spent my weekends testing this and building it and back testing it with data of companies we had, and then worked some other friendly VCs saying, just check this data. And we were getting it 100%. It was just, this was all right. And people were looking at that thinking, how did you do that? And then it was an interesting time because it took quite a while by myself. It was bootstrapped and we just covered the Singapore incorporated companies, but that's the most important because many startups around Southeast Asia incorporate in Singapore. And this is the thing that really surprised me. I built something and I knew nothing, tech platform. I had no idea, but we built something and then I looked at it and I thought, this everyone will want, everyone. And I had such incredible confidence. What really surprised me is no one wanted to see it initially. And that to me was demoralizing. And I knew if they saw it, they would love it. But initially I said, Jason, we don't want another Crunchbase. And these are VCs I knew. And I thought, geez, this is so difficult. So it took 3 or 4 months. And then people started to read the newsletter and they say, hey, we didn't report this. How did you pick it up? We started to get a few more queries. And then step by step, a couple of VCs said, okay, let's have a look. And I'd be pitching, giving it my heart and everything. And within 5 minutes, I said, Jason, stop pitching or buying it. I just want to know how you're doing it. We had VCs handing over the credit card in the demo, right? It was like, wow, sign me up. And I'm like, actually, I haven't got access. I can't take your credit card. But just that you never, sometimes you just don't anticipate what will be the biggest challenges. Yes, I'm going to build a product, challenge all the way there, and then it's going to sell like hotcakes, maybe if people see it. But now we've got 75% of all the VCs in Southeast Asia as customers. So we had to build new products because we've just so dominant. There's only so far you can go. But it wasn't always easy.
What's interesting is that you now probably are one of the most clued in at a macro level across the region. Because I think one thing I've realized is that working as a VC is that I think a lot of people are looking on a quantitative sense or an individual sequential way, but you're the only one who's kind of looking at this longitudinally and across the whole ecosystem. So any particular things that have surprised you over the years because you have all this data, any particular tidbits that you want to share?
I was amazed by how quick valuations went up a couple of years ago. And I think everyone else could see that was unsustainable. I was surprised by the number of companies they funding when they would survive. I was surprised by the growth in the VC space. And back in 2012, thereabouts, there were really just a handful of funds yet. Jungle, Golden Gate, East Ventures, of course. And Jungle's first fund was 8 million and they just raised 600 million. So you had a handful of funds and they were tiny. Now you've got 250 plus VC funds. Add to that many family offices. They're just in Southeast Asia, and family offices, strategic, super angels, blah, blah, blah. The size of the investor base has grown dramatically. You've got late stage investors that were going in a pre-IPO Series F, etc., realizing they couldn't get access to them, came all the way down to Series D, C, and sometimes Series B. This is sovereign wealth fund. So you had all that excitement, and then you started to get foreign interest, which is great. Now, obviously, that's slowed down a little bit. But it was tremendous to be, and you were part of that, Jeremy, just to see that growth in the ecosystem. It was really exciting to see so much happening. And I think Southeast Asia will continue at a strong growth. Obviously, the whole market seeing smaller rounds, and that's what we're seeing now because we've got the data. We can tell you what's happening. You're actually seeing more companies funded now in Southeast Asia than ever, but the round sizes, particularly at growth stage, on average, are much smaller. So that's an interesting thing, right? One of the other things that shocked me was if you give a founder lots of money, they often, no matter how smart they are, they often won't be able to utilize that in the most efficient way. And I don't want to pick on young people because young founders are often the best, but you give someone 25, say $50 million US, and they've only worked for a couple of years for someone else in a pretty junior role. It's like, what do you expect them to do? And of course, they think the expectations is they've got to grow. So they hire like crazy. They're going out and doing this, and then that didn't work, and they shut down, and that didn't work. If you give people a small amount of capital and they can be very capital efficient, which some of the funds do. And of course, they get priced down in some of these rounds, but some of them do. It really makes founders think with alternatives. And I've funded that myself. So we had to be very thoughtful until we got to about 40, 45 people. And then we've just taken our first institutional capital this year. You had to be very careful. It's, okay, I really want to hire that guy. Okay, got to add a few more customers. Right? Make it work, get to a point, justify it. You really think about spending on data and products. When you're using a lot of money from someone else, you think about it, but in a different way. And I just think so many companies got funded with too much money, and that those companies may have succeeded, but now their downfall is so much, the fall in their valuation is so much, it's going to be so high because all of the people with ESOP said that's underwater, right? So unless you're going to reissue everything at a new price. And I think just the spirit within the company as they get through such a fall, it's pretty hard to recover sometimes. And with the other thing that shocked me was in the frothy days, going back 2 years ago, very young companies getting huge valuations. A couple of years, hundreds of millions of dollars, making no sense, almost no revenue. And not only that, selling millions of dollars of shares of the founder. So he's taking risk off the table. He's put no money in. He's getting millions of dollars out. It's just the whole wrong incentive. It's not happening now. That was happening. And that surprised me.
Yeah, I think it was surprising because we could hear it, but of course it'd be a time lag. And so I always be like, Is that true? It is true. So such is life. So it's interesting because you open up access to that information set. I'm sure you got a lot of pushback as well because information is power, right? And so to some extent, when you make it flat, people don't like it. Could you share more about that?
Yeah, we did have a small number of startups, not many, come and say, this is illegal. It's a private company. So we'd have to explain to them, private company does not mean private data. In fact, all the data is accessible in ACRA or SSN or the equivalent across Southeast Asia, but there's no valuations in ACRA. So we pull everything to make it informative and accessible. We've had one or two offer to pay us to remove their data, pay us reasonable amounts too. And these were companies I hadn't heard of. And I thought, what do you do? We've had VCs. None of them has actually, I think they just accepted it. And by and large, it's very net positive for VCs. Of course, but it opens up everything, right? So you can see what you invested in each company and what it's worth today. Did it work out? Did it not? But that's part of the course for VC. We're always going to get some companies that don't work out. The fund performance is probably the one that's a bit different. And I told a lot of people when we launched this product, I'm going to win some friends, but I'm going to lose some friends because you're either a winner or a loser. And if you're up the top, yeah, great, put it out there because I didn't give it to Preqin. They haven't got my data. Okay, fine. You want to say I'm one of the top decile? That's okay. But if your performance is not good. So we thought long and hard about that. And we're a VC, so we're open to the same benchmark. But we think transparency as a whole is beneficial. But as you say, there's always some people who could benefit by lack of transparency. But I think for an ecosystem, it's a good thing. The other good thing I think is from a founder's perspective. We founders were often saying, oh, I've got to raise this because X raised this. I've got to do this. And they didn't know really whether that was true. And the VCs had a much better access. So it opened up the ability for the founders to say, oh, hang on, I actually can now go and check on my competitors. I can see if this VC is actually really followed on. How much have they put into these companies? Do a bit of due diligence on them. So it gave them that capability. How do I work out my valuation? Oh, I can see every valuation for every fintech and Series B in Southeast Asia with their revenue. Now I can try and justify it when I'm talking to a VC. How did you come up with that? I looked at every company you invested in and all your peers, and this is the valuation. Before you couldn't do that with confidence. So mostly positive. 99% positive, just a couple really surprised saying, remove my data, which we did not.
And you mentioned that you also invest as well. Can you share more about that?
On the GenCap side? Yeah. So we are again, B2B for the reasons I went through before, but we're seed stage. And the reason for seed stage, Qualgro was A and B, but we see seed stage has better risk return. Obviously, if you get the right company at seed stage, the multiple is going to be higher, but it's higher risk. So you want to get the right. Now, everyone knows the Series A, B companies because we publicize it. It's all out there and it's usually no secret. Even the most in the loop VC don't know more than 5% of all the unfunded startups because there's thousands of them. So if you could use data to access more than a Sequoia, for example, because we can't build a bigger brand than Sequoia. It's not possible. But we can use data to see more companies than them at the early stage because we do something quite different. So that was the idea. And we've done that. So we've now got January Capital, 5 engineers and data scientists in-house. And we also had, with the only VC to get a grant, 7 figures from the Monetary Authority of Singapore to build out our own data product called First Signal, so that we can see when startups are incorporating, we can see the quality of the founders. We can use it, get a front end and filter it. Educations by work history, because we know where a lot of the good founders come from and their backgrounds. And so that's why we went in that stage. So very much on the equity side, seed stage B2B, and we just launched venture debt for growth stage companies. And we did that because all of our growth stage companies, the one complaint they had is we can't access credit. There's no venture debt for us. None of the existing players, Great Firm, and Genesis, they all do typical check sizes, $2 million, 2 to 3. And so we saw this huge demand, and it's great to be in a space that's not competitive, right? So you're not sort of competing head on with lots of other lenders. So we hired a CEO, so he's fantastic, the most experienced venture debt person in Southeast Asia. He's brought across one of his best analysts who's joined us, and we're building up that team. And we've done our first couple of deals, $15 million each. So we are really at a different space. And the demand is huge. Every growth stage company we've spoken to said, I'm interested in venture debt, whether it's right now or in 12 months. I definitely want to talk to you about it. So things are going well. High interest rates are great if you're a lender, not so much if you're a borrower. So that works for us. And it's the perfect time for venture debt because high interest rates, huge demand, and valuations are really, really low, which is great because you get your warrants at today's strike price, which is today's valuation, not 2 years ago when you'd be underwater. Fairly optimistic about where that's going to go.
How do you think about venture debt as an asset class? Because those are the macros. But what do you think are some of the that people should be mindful of?
From a borrower's perspective or
I think from a lender's perspective.
Yeah, and it's interesting. When we were fundraising, one of the biggest challenges we had is most institutional investors didn't know it or just did not know much about it. to the point where they couldn't invest. Because in the US, it's huge. It's about $35 billion a year, estimated to be more than 15% of all the capital. Massive. In Europe, it's growing very fast. And BlackRock just acquired Creos, the largest venture debt player in Europe last year, showing the biggest allocators in the world find this exciting. Many of the players in the US are listed, and you can see their returns through the cycles, 20% on average through cycles. Incredible risk return. At growth stage, for us, because of lack of competition, we believe we'll do better. So equity returns, very low credit risk. But, one of the things people ask you is, well, why wouldn't I invest in a growth stage fund as opposed to a venture debt fund in growth stage? And for us, it was pretty clear. We said, if you have the best outcome possible for a portfolio company, you will get a better return on the growth stage fund. A bit. They'll want 25% IRR or more, but if they get a great outcome, the venture debt will get close to 25% IRR because your interest and fees are giving you mid-teens. The warrants, if it's a great outcome, will drive it that fund. In every other scenario, you will get more money in venture debt. So taking a scenario where the VC gets a 0% IRR and they just get their money back. The venture debt will get mid-teens because you have to get your interest and fees before they get a cent. Or take a scenario where the VC loses all their money. Venture debt typically amortizing. You're going to get all that money out first, and then you're senior secured. So whatever value is left, you take the rest of it. And of course, if that's seed and Series A, that's not much. But if that's a company that's Series D that's worth $500 million, you can be pretty sure if it runs out of money, there's probably $10 million of value somewhere that you can get to cover your loan. The last thing I mentioned there is what you look at. So people say it has to be high risk. You're lending to companies that are unprofitable, that don't have real estate as security. And the answer to that is you're not getting funded the same way as a traditional lender. You are getting funded from some of the cash flows. But by and large, you're looking at, is this company very likely to raise at least one more? Because if you amortize over 2 to 3 years, companies raise every 18, 24 months. They raise one more round. You will definitely get all your money back. You'll get a mid-teens return and you got your warrants as well. And so that's what we really look at. Quality of the investors. We look at obviously the performance of the company. We look at its trajectory. We look at how important this company is in each of the investors' portfolio. We talk to the investors and we get very high conviction that this company will raise, even if it's a down round. We get a mid-teens return. So it's a great place in terms of risk return.
On that note, could you share about a time that you personally have been brave?
I personally think that every founder is brave. Everyone who does something new that is inevitably got a high risk of set up a podcast or you set up a startup. I think it's even more so when you do it when it's highly visible, and even more so when it's highly visible to your peers. So I was launching a startup and I knew data and filings, but that's something that I think I know most, maybe better than anyone, but I didn't know anything about setting up a tech platform, and I didn't know anything about all the software I need to do to make this work. And that was daunting to me. And so I knew the risk of getting all this too high, and I was going to do this without being full time, which just makes it even more unlikely to succeed. And if it didn't succeed, every VC would know that I tried and failed. And every other startup, because we weren't talking to them, probably would have known that as well. And there's nothing wrong with failing, of course, but none of us like to fail. So for me, it was that point where I thought very, very hard. Do I want to do this? Do I want to go out really hard and public, say I'm going to do this and take the risk that it might not succeed with all of my peers, all of my colleagues looking at me? Because I can guarantee you there would have been so many people who had told you so. But that was a game changer for me because it made me take other challenges with a different set of strength. I'll give you an example. Once I did that, I said, to succeed in this, you've got to give it everything. I said to myself, I no longer have a right to say, I don't want to pitch to someone. I pitch to anyone. I pitch on weekends. I pitch in my sleep, and I'll pitch to anyone, and I will chase people to get in front of them. And that was hard because I was never the person. I'm an introvert, Myers-Briggs sort of personality test. That's not me, but I never miss an opportunity. I meet anyone. If I think they're remotely interested, I hit them and I chase them, and I don't care. I don't have the privilege, I tell myself, to have weekends off ever. And I haven't had a weekend off in 5 years. I said, if I'm going to do this, I'm going to do this. But I also said, I don't have the privilege not to be afraid of public, to be afraid of getting up in front of 300 people and talking. Now, everyone's a bit anxious about public speaking, and myself included. But I said, no, I'm not going to run away from it. I'm going to run head on, and I'm going to do as much as I possibly can. I get up at separate returns. I get up at VC conferences. But now it's really helped because now I don't feel that fear like everyone usually does. And I feel now that any challenge that comes, I take it with a new sense of, look, I've just tried to do something that I thought had a very high risk of failure, that had a lot of reputational risk. And that's, if anything else fails, I'm okay with that. So that's when I think I've been brave, taking that risk to set up a startup and doing it without being full time and doing it in a place where knowing everyone would know if it didn't work out. And knowing that I didn't know much about anything except data, I knew nothing else about building a startup business. Even as a VC, I didn't know how to build the nuts and bolts. So I had to pull in a lot of favors. Fortunately, it's been successful.
You've definitely grown a lot over the years, right? As a lawyer, as an investor, and now as a founder. If you could travel back in a time machine back to the Asian financial crisis, you're a lawyer in the office, like you said, people were getting fired to your left and to your right, and you were able to, I don't know, grab your younger self for a drink at Lang Kwai Fong, a bar. And what advice would you give to yourself back then?
Yeah, it's a great question. The one thing I think I sort of got into law with the mentality that I will just nonstop work to become a partner and then make it a firm. And I got to become a partner. And then it was like you work so hard, you give up so much of everything, and you work in an environment that some people enjoy it, but I think most people don't. The advice I would give is that if you think that everyone should think about whether they want to run their own business, because you control your own destiny. And you can also, if it's successful, wealthy and everything that goes with it, but you're also your own. You can't underestimate how positive that is. It comes with a lot of baggage and dealing with people. I would tell people to think about it soon. And I know a lot of young people do it sooner. And if I had gone back, I think I would have jumped sooner. I would have gone, I love doing the VC and I'm going to keep doing that because I actually love it. But I think I would have gone out of the sort of large institutional stuff much quicker, taken some risk earlier and gone and tried to do something that was really dependent upon myself to be successful.
Thank you so much for sharing. On that note, I'd love to kind of summarize the 3 big takeaways I got from this conversation. First of all, thank you so much for sharing about your early legal journey as a lawyer in Australia, in Hong Kong, in Bangkok, and very fascinating to hear how you were thinking about the business, but also looking at how the different geographies played out in terms of how to recover shareholder outcomes, but also how to negotiate some tricky situations. Secondly, thanks for sharing about your perspective on Southeast Asia venture capital. I think obviously there's a lot of optimism and pessimism. And I think you're sharing this quantitative point of view on what has actually happened over the past 10 years in terms of the ecosystem, not just in terms of the startups, but also on the VC side, the supply of capital and the investment discipline that people have been exhibiting as well. Lastly, thanks so much for sharing venture debt as well as instrument. I thought it was fascinating to hear about how you think about it in terms of why now is the right time in terms of the macroeconomics versus the asset class versus the operating parameters to do it. And I think it also ties back to your early points that you had about the discipline that founders need to have about the capital they receive and how investors should be prudent in helping founders navigate the most capital efficient choices to grow their company properly and really survive. On that note, thank you so much, Jason, for sharing your journey.
Jeremy, it's been a pleasure. Thank you for having me on the podcast.
Thank you for listening to Brave. If you enjoyed this episode, please share the podcast with your friends and colleagues. We would also appreciate you leaving a rating or review. Head over to www.bravesea.com for member content, resources, and community. Stay well and stay brave.